Hey, what's up, guys? Kezon McNeill. Welcome back to the Kezon McNeill Show. Hope everyone's having a wonderful day and an even better year. So today we're going to talk about just a real life example of how I use my insurance policy to really get out of debt and to also buy things, luxuries that I love. Right? Not sitting around here eating rice and beans and not taking my kids out, not taking my wife out. We're having fun. We're still living life, enjoying life. We've just changed the way that we think about money. So I'm going to give you guys a really quick example on how I've actually used one of my insurance policies to purchase a luxury item, and still have the same money as if I didn't ever spend the money. So I'm going to jump into a quick demonstration. Let me put my headset on, and so my mic. I have to use this big mic because I'm gonna grab my watches here in a minute, just so I can kind of just show you guys a real life example. Because I know sometimes we hear people talk about you can use this to buy this, you can use your insurance policy and do this and do that and all this great stuff, but you really don't understand how powerful this product is if properly designed and structured right. That's the key word. It's got to be structured properly. But first, before I go any further, hit the like button. Share this video with someone in your network. All you got to do is hit the share button, send it to someone in your cell phone that needs to get out of debt, that needs to start banking differently without changing their habits. We just want to basically repurpose the money you're already using, okay, and use it more efficiently. I just want to explain to you. So these are two Rolexes that I bought myself and my wife. Um, about five, let's say about 5 years ago. And what I want to show you, and what I want to, the reason why I show you this is because I want to kind of explain to you just the simplicity of private banking or your own family bank or whatever we're calling it, right? So just imagine, okay, I bought these two watches, right? So let's imagine you buy the same two watches for yourself and your significant other, right? It's going to probably work like this. You're going to probably either pay cash for the watch, and I think total for these watches, total was probably close to $19,000. Maybe a little less, maybe about 17,000 total for both, right? But let's just say 17,000 for the example, right? So what you would probably do is one or two things, right? You're going to finance it with the Rolex dealership you deal with, all right? Or you're going to put it on a credit card and then just pay the credit card off. Or you're going to cash out on it, meaning you're going to just pay straight cash for it. No bill, nothing, right? In all of these examples, we know if you finance it, you're going to pay interest over time and, whatever. But now the bank that you're financing this with, they're the ones going to make the interest off of it. They're the ones who are going to make the gain off of it, and that's what they want you to do. So they can do what, loan that money to other people, right? Now, you could cash out on it and say, "Man, I'm not paying any bills. I'm not paying any nothing. I cash." All right, there we go. I cashed out on it. All done. Everything's all gravy. I don't owe nobody nothing. No interest. Yada yada yada. Sounds good. But when you do cash out on it, that 17,000, you had to get it from somewhere. So you probably got it from your savings account, somewhere, checking account, and you cashed out on it. Cool. But you lost that 17,000. So even though you cashed out on it and don't have a bill, you got to put that 17,000 back. Right. So you do what? Start to replenish your savings again and start saving up again, and whatever. Yes, you don't have a bill, right? And then again, sometimes people may put it on a credit card and pay the credit card off. Obviously, you know that how that goes, just like financing. You're paying the credit card company back and they're making the interest, et cetera, et cetera. But what I did was I took money from my private bank, right? So I took a $17,000 loan from my private bank. Yes, I had the money in the private bank, but I didn't use my $17,000. Think of it as real estate. Like when you have a house and you want to borrow off your house, they usually give you anywhere from 60 to 70%. Usually it's about 60% LTV based on the equity in your house. The life insurance policy works the same. So had a certain amount of cash value. The insurance company looked at my cash value and they said, "Oh, okay, you got that. We'll give you our 17,000." right? So for that, they charge me just under 5% simple interest. As a balance, they charge 5% of that in this example. So I took 17, right? So they charge me whatever the balance is at the end of that year. And if I wait a year, it's going to be $850, right? So what I did, I was in the store, pulled out my Amex, put it on my Amex, cashed out, gone, right? Now, while I was there with my Amex, I'm walking back to the car with the watches, all happy, etc. Can't wait to surprise you know what? We were newlyweds. So surprised my now wife with this amazing gift. She wasn't looking for a Rolex or anything like that. Just the way I look at it is my father said, don't buy it if you can't buy it twice. And so I wanted to buy my wife something as well. I want her to be able to enjoy, these nice things when I have these wins and things like that. I want her to play a part of that with me. So, whatever. So anyway, as I'm walking back to the car, I just go on my app on my phone and I do a policy loan for $17,000. Done. And right about 4 days, that money hit my account. And what do you think I did? I took that 17,000 and I immediately paid off the credit card. Done. So credit card is paid off back to a zero balance. That $17,000 again. I didn't use any of my money. I just used other people's money. You may hear that being said a lot. In this case, it was my insurance company's money. But the cool part about it is, notice I didn't have to fill out any paperwork to get this loan. Nobody checked my credit. And if I don't pay back, no one's going to report me to the credit bureau and all those great things. I didn't have to put any money down, nothing. Easy transaction. So yeah, I cashed out on it too. But the difference between most people cashing out is they don't have that 17,000 anymore. My 17,000 is still sitting there, still growing uninterrupted, compounding. Every month it's compound. I'm sorry, every day it's compounding, right? So what I do now, I say, well, shoot, I'm gonna pay the $17,000 back. What do? I say, all right, I'm going to go ahead and pay $300 a month to it. Then some months I may stop around the holidays. I ain't paying nothing, whatever I choose. So started paying the money back, and sometimes I lump sum it, whatever. But again, I didn't have to pay it back, right? So I paid the money right back to the insurance company over a period of 24 to 28 months, something like that. I don't even remember what it was, but put the money back, in business as usual. My money kept growing, never lost any of my money, so that is the best example I can give you. I know sometimes you hear people talking about borrowing from the policies or taking loans from the policy, and they don't really understand how that works. But I wanted to just show you guys, like, this example could have easily been a vacation. You could have been paying $10,000 for a vacation, and then you put the vacation all on the credit card, like we all do. We know how that goes. But now you have a resource to pay it right off. So your credit score stay well. You keep your credit card balances low, right? And, business as usual. But that is what we call private banking. That is what we call family banking. So my goal for my family is, right now we have close to I think 8 policies to be exact within our banking system that all have cash value in them, right? So at present, we're using these policies to get out of debt, right? So we're on course right now to be totally out of credit card debt, and including car notes and revolving credit card and revolving accounts and things like that, like revolving loans. We're on schedule. Initially, it was 24 months, so we probably looking at another 12 to 13 months or so. And it's been amazing, to seeing the debt come down and then seeing our credit scores continue to go up, right? But that's just like a really, real life example of actually using my insurance policy through my banking system to make a purchase, right? So what I like to tell people is, because sometimes when we talk about get you out of debt in 9 years or less, sometimes initially people just don't really believe that, and I totally understand that. I get it, man. The masses, it doesn't resonate with them, and I get that. Initially, I didn't really understand the concept. If I'm going back to now 2020, I didn't understand the concept. But yet I was using it back in 2017 when I purchased these watches because I had cash value and I knew how to use the banking system. It's just that now I have a system set up, got trained in this software, got trained in this concept down in Jacksonville, Florida. And it's really changed the way I think about money, and it's improved my relationship with money, right? So what I want you to think about is, no, I'm not sitting here telling you, that, oh, get completely out of debt, pay your house off, all that. But what if you could get just out of your credit card debt? What if you could get out of your card debt, just those bills, and only had a mortgage to pay, or only had a school loan to pay, right? Imagine how much money would be freed up for you to do what? Go invest in other things that can bring you in more money, or to stack the money further in your insurance banking policy to do what? Create more income, to create more retirement income when you, and if and when you do decide, to retire. So think about it. It's real. I would encourage you, to set up a meeting with me to talk about getting out of debt or just changing your habits with banking. Um, this is exactly what banks do. You know, if you look up where banks spend their money, you can find this information on Google. It's easy. Find out where your local bank invests most of their money. You'll see about 60% of their money is in life insurance. Yeah, it's called BOLI, bank-owned life insurance. And if you've been on social media long enough, I'm sure you've probably heard of this. But that's what banks invest their money, man. Life insurance. It's guaranteed money. It's safe. But yet, when you walk in the bank, what do? They try to get you into a money market account. Maybe buy some stocks. Maybe buy a mutual fund, some CDs, right? Maybe take out a line of credit with them. You know why? Because they need your money to exist. Think about it. If banks didn't have your automatic deposits coming in from your paychecks, they wouldn't be in business. Because what happens is when they get your paycheck, they go loan that money out 9 times over. Just look up fractional reserve banking, if you needed more explanation on that. So what we're doing and what I'm teaching, at least in my family and a lot of my clients that have bought into this, is teaching you how to slowly get rid of the banks. Because right now the banks are controlling our lives, right? We get our direct deposit from our paychecks and we immediately pay bills with it. We pay a credit card bill, mortgage, whatever bills. And then if there's money left over, we pay ourselves a little savings, right? So we're just trying to change our habits a little bit, right? When any money profits from business or employment hit my account, it immediately goes to my insurance policy. And then I decide what I want to do with my money, right? That's kind of how I've been doing it for the last 5 years. It's been working for me. It hasn't been like this crazy super adjustment where I have to take less and all that. It's just have to change my habits, man. That's it. Because if you're used to doing something one way, and that's how you've been taught, that's how your parents were taught, that's how their parents were taught, their parents before them were taught. It's hard to break that cycle with, because they make it so easy to get a loan. They make it so easy. But now the world's changing. Interest rates are going up. So now cash is king. Cash is becoming king again, right? And so when cash is king and you want to use credit, you better have great credit. Not good credit, great credit now. Now they're looking at you if you don't have at least a 700. It's a hurting feeling, man, to want to go out to a department store and go buy something and your credit's messed up and you just hoping they approve you. Because if they don't approve you, you don't got the money to pay for it. And that's a hurting feeling, man. So part of this getting out of debt process, your credit scores are going to automatically get better because you're paying off debt. So now when you go to this department store, want to buy some furniture, a bed, or whatever it is, and you're going to get approved for that loan. But you also know that you may make one payment to that lender because you're going to pull the money out your private bank through your insurance policy. You're going to pay that loan right off. Boom. And now you're going to pay yourself back at the rate you want to pay it at the pace you want to pay it at. All right. So I hope you guys really get something out of this. And I just encourage you, take a look and see what your numbers look like to get out of debt. It doesn't cost you anything. Super passionate about changing the landscape of how we think about money, but keeping it simple at the same time. You hear people preaching generational wealth. They're preaching all this. We're going to get rich and all this great stuff, but no one's talking about the foundation. Just let's get your debt under control first, because common sense should tell you that if I am keeping more of my paycheck versus paying it out to debt, man, I feel a lot better. I can do some things, right? Credit scores are going up. Qualify for this, qualify for that. Now I can really use other people's money the correct way, right? So hope you all got something out of this. Do me a favor, please hit the like button. Also subscribe to the channel. It really helps reach make this video reach more people. YouTube's algorithms are really funny about that. So again, I appreciate you guys watching. Maybe copy this and share it with someone in your cell phone. People need to see this, man. They really need to see this, and I'll encourage you. You know, if you've been putting it off and putting it off and putting it off, stop putting it off. Stop worrying about what what people are going to say. Look at your situation right now, and if you're being honest with yourself, we all have debt in common. But even outside of that, notice I didn't even say life insurance, but this is what this is. The vehicle I use to do this is life insurance, but it has to be properly structured for cash value. Everybody can't design policies like this. They're going to tell you they can, but they can't. And here's a little nugget for you when you decide to um, get all gung-ho from this video, and you're going to go out to your homegirl or your homeboy or your cousin or your uncle and say, hey, I want one of those cash value policies, that's going to create income. I hate to say it, but I'm going to tell you what's probably going to happen. They're going to design a policy for you, and they're going to do it with their commission in mind, how much money they're going to make. So it's not going to look right. It's not going to be done right. If a properly designed cash value was done correctly, you should see money right away. Depending on the product, you should see money in 30 days or at least by the end of year one. Okay. So remember that. And here's a little nugget for you as well. Whatever agent you deal with, ask them to show you their policy. You should see loans outstanding, something going on, or policies maybe, or just show you one policy where they're actually implementing what they're trying to get you to do. Right. That separates the men from the boys and the women from the girls, because a lot of people talk about these concepts and they'll say, buy term, invest the difference. Only use whole life, only use IUL. I use them all. It just depends on the customer. The client is what dictates what's needed. Right? It's kind of like if you go to the doctor's not going to give everyone the same medication. Why is he going to give you high blood pressure medication when you got diabetes? Right. So you have to be working with someone that really understands how this works. Right. Hope you guys really got something out of this. Again, I'll see you guys on the next episode. Like, share, subscribe to the channel. And again, thank you for all the support. And here's to getting out of debt. Peace.